Hello and welcome back, guys. So in this particular session, what we will be discussing about is SPR's question number 12 exam kit angel. Okay, so what we've been given is that, so it's a very long question, and then we've been given SOFP, SOPL, uh, and then statement of changes in equity, everything. Okay, so angel question number 12, and then the following group financial statements relates to angel, right? Public limited company. So what do we have in assets? Non-current assets is PPE, goodwill, other intangible assets is also there, investment in associate, and then financial asset is also there. So there has been few changes here and there. Okay, and the other thing that we need to remember is this thing: current assets is inventory, trade receivables, cash and cash equivalent is also there. And then in case of equity, there has been few changes as well due to acquisition, and then return earning has changed, other component of equity has increased, right? And NCI has increased as well. So let's look at the back side of this. So in case of non-current liabilities, what do we have? So long-term borrowing that will basically affect our financing component, right? Financing activities. And then it has decreased by how much? 26 and 57. That will be our payment, right? And then deferred tax will be required in case of tax calculations below cash from operations. And then retirement benefit liability, this is for reconciliation, right? And then we have trade payables, tax payables. Okay, so SOPL is also given to us, which is COS. Other income is also there, administrative expenses, other expenses is also there, finance cost, share of profit of associate, PBT, income tax, and then profit attributable to. And then what do we have in items that will not be reclassified are actuarial loss on defined benefits plan, right? That's there. And then revaluations of properties also there, 8. This will be important when we are calculating our PPE, right? And then items that may be reclassified to profit or loss in case of financial asset. What kind of a financial asset that we reclassify is only debt. Okay, always remember that. So when it says that items that will be classified, and if it's a financial asset, it's always debt. Okay, and then what else? Tax relating to above is -2 -1, right? So that's there. And then statement of changes in equity, all we need to be careful about is this: what was the dividend paid? Okay, that is very important. So dividend paid was 10, right? And then in case of NCI, how much did was were they paid? 6, right? So this dividend was paid to parents equity holders, right? And then in case of any other things that we need adjustment, nothing over here, but we will need to look out for associates dividend, which will be in investing activities, right? So what are the information that we've been given? Okay, the following information relates to the statement. Okay, so on December 20x2, Angel acquired all the share capitals of Sweetie for 10 million. So what's our year ended? 30th November, right? So it's in 30th November. That means exactly 1 year ago. Carrying amount of net identifiable assets in individual financial asset, financial statements, and the fair value are set out below. Together with their tax base, goodwill arising on the acquisition is not deductible for tax purposes. So there was no other acquisitions in the period. The tax rate is 30%. So this is the value, right? So even though it's in carrying amount, what we normally do is that, remember, like we've always been telling, like according to IFRS 3 business combinations, when we are acquiring a subsidiary, we value the assets at fair value, right? So this will be our fair value. So it will be 20, okay? Whereas the carrying amount is only 16.3, right? And then the tax base will be near to the carrying amount, right? So 15 million. So this will create a deferred liability, right? Because in, suppose tomorrow we will sell it, someday we'll have to sell it, right? In that period, what we will do is that we will realize that gain, right? So in that period, we will also have to pay the deferred tax liability, because your tax base will only be 15, whereas your fair value will be 20, right? So the difference being 5, and then the temporary difference is 5, and then 30% of 5. Okay, that will be your deferred tax liability. Okay, so we've been given retirement benefits thingy as well, reconciliation. So net obligation at this figure, and then net interest this, service cost this, contribution to scheme is this, remeasurement component is this. Okay, so what else do we need to solve in this is that the benefits paid in the period by the trustees of the scheme were 6 million, right? Okay, Angel had included the obligation assumed on purchase of Sweetie in the current service cost above. Obligation assumed. Okay, although the charge to administrative expense was correct in SOPL and OCI, there was no tax implications regarding the retirement benefit obligation. Okay, so this one should be eliminated, right? There is something to do with that one as well. So it had included, right? So it should not had actually include that in case of thingy. Yeah, that's what. So your net expense will be 8 minus 17. Okay, so defined benefits are included in administrative cost. That means it will be reduced from. So basically what you do is that service cost is generally charged to SOPL, right? So we will have to eliminate that as well. So what else are we required? So we've been given PP carrying amount this, cash proceeds this, so there has been few disposal as well. So carrying amount of this was disposed for this amount. Okay, so there was a gain, right? And gain on disposal is included in that, means it will be also reduced from our operating activities, right? Adjustment for non-cash item. And then depreciation will be on the right hand side, right? 29 million. And then we will have to create a working for this, and then in case of associate we will do as required. So in case of associate, what has happened? 30% interest in associate for cash on this much. The net assets of the associate at the date of acquisition was 280, and the associate made a profit after tax of 40 and paid a dividend of 10, right? Okay, so this plus this minus this, and then 10 million out of this profit in the year ended 30th November 20x3. Angel does not hold investment in any other associate. Okay, so we don't have the cash paid for associate, right? So what we can do is that we can simply basically find out uh, by knowing what was the profit for the period was 40, right? Okay, and then our share will be 12, so 12 minus 3, right? Okay, we'll find it out, don't worry, not a big deal. So in case of impairment test carried out at 30th November 20x3 showed that the goodwill and other intangible assets were impaired 100%. So impairment of goodwill relates to 100% owned subsidiaries. Okay, the following schedule rates to the financial asset owned by Angel. Okay, at balance it was this much, carrying amount of financial assets disposed of was this much, and then gain or add purchase of this was this much, and then gain was this much, right? So where will we need this figure? Why have they given it? It's because we need to compute it in case of investment, right? So that will be there, and then the sale proceeds of the financial assets were 40 million. Okay, so it's already been given, right? Profit on the sale is included in other comprehensive income in the financial statements. Okay, so it's included in OCI, right? Did we see anything of that sort in OCI? OCI, yeah, there was something, right? Four. Was the gain four only? Gain on, yeah. This was included on there. Okay. So finance costs were all paid in cash. So all of the financial cost incurred. Okay. Otherwise, if it had been normally finance cost is a accrual basis item, right? So if there was any cash payment, then only we would recognize it at as interest paid at the bottom, right, below cash generated from operations, whereas in this case everything has been paid out. So we are required to prepare consolidated statement of cash flows using indirect method for the year ended 30th November 20x3 in accordance with the requirements of IAS 7. The notes to the statements of cash flows are not required. Okay, easy. So let's go into this directly. Okay, statement of cash flow for the year ended 30th November 20x3. CASH cash flows, right? And then what we need to figure out is profit before tax. So what was our profit before tax? Profit before tax, and then after that finance cost, right? Finance cost, add investment income, add share of associates profit, right? And then adjustment for non-cash items, which are basically first thing first depreciation, right? And then after that profit or gain or loss on sale of subsidiary. Same thing, gain or loss on NCA, non-current assets, or PPE, right, in this case. This is basically gain, right? Gain has happened, and then in case of subsidiary, I don't think it has been disposed of. Impairment of goodwill will be another thing. And then retirement benefit will be costs, right? So benefit expense, basically the service cost, right? Isn't it? Where is it? Service cost. Yep. Service cost. Okay, so let's prepare the workings as well side by side. So in this case, PBT will be how much? PBT is 188, right? 188. 188. What's our finance cost? finance cost is 11. We add that thing up and then we subtract this figure 11 and 12, right? 11 and then 0 and then minus 12. Minus 12 depreciation we will need to calculate, or we've been already given. We've been already given depreciation is 29. Where was that depreciation? Over here on the top right. 29 minus 29, and then gain or loss on subsidiary has not been disposed of, right? It's only been acquired. It does not say anything about disposal as far as I have read it. Yep, it's only about acquisition, so no need to worry about this. So PP. Okay, so working note 1. Working note number 1, PP. Bold, right? So particulars, amount, amount, copy, paste. Particulars, right? Bold it to opening balance. So what was the opening balance? Opening balance was first page. Opening balance was 465 and 475. 465 and then 475, right? 475 by closing balance, right? And then by depreciation, first thing first, depreciation, there was few disposal as well. Depreciation DEP, so this figure will be minus this figure, okay? 29. And let's move this down. CLO, closing balance. And then again by disposal was how much? What was the carrying amount? 49, right? 49 million worth. Disposal 49. Okay, that's done. There was a revaluation as well, right? To revaluation. Was there any revaluation? Where did I read it? Revaluation. Yep, it was. Where was it? Was over here. 8. To revaluation 8, right? And then after that to acquisition. So acquired PPE was how much? 14, right? Because that will be our carrying amount. Anything else that we are missing? I don't think so. Should be good. Sum of everything. 53 equal same figure over here as well. And then this figure will be this minus this minus this minus this. So this will be our to purchase, right? Purchase, which is balancing figure. Okay. Mm, okay, so in this, we did not need that figure, but still, because we were only required to find out the gain on PP, right? So what was the gain? What was the gain? Where is it? So 63 minus 49. 63 minus 49. 63 minus 49, right? Okay, so 49 minus 63, because it has to be deducted, right? Impairment of goodwill. Okay, so for that we will have to calculate everything. So working note 2, calculation of net assets. Calculation of net assets of Sweetie. We know the opening goodwill, but we don't have the goodwill for acquired thingy, right? That's why we need to calculate it. Okay. So what have we been given? Acquired all share capital at this much, and then after that, the fair value reflected in year-end balance of this was this much, right? Okay, so it is 20. We can see that very clearly, right? So working note 3 will be calculation of goodwill, right? Calculation of goodwill, which is basically cost. So since there is no thingy, less minus this, cost is 30, right? 30. And what we need to worry about here is the deferred tax thing as well. Okay, so calculation of deferred tax. Sweetie, right? Mm, Carrying amount was how much? 15, right? No, tax base was 15. Base was 15. Then fair value was this, and then temporary difference, mm, difference, this minus this. Tax rate was 30%, right? So deferred tax liability DTL is this into this. So 1.5 will be added over here. Deferred tax, because that is also your, that will also be added, right? So sum of all this, right? 7.5. Goodwill at acquisition, bold it, and then working note 4. Now we have the goodwill for acquired, so impairment. Impairment, right? So in case of impairment, what do we have is, let's prepare our chart again. Control V, and then what's our opening balance? Opening balance is 120, 105, 120, 105, 120, 105. There won't be any revaluation. That won't be there. There will be few purchases as well, which will basically be the same figure. And then was there any impairment? I think we are not given impairment, isn't it? Impairment. I did not see any impairment figure. Impairment. See over here. Impairment test was carried out over here, and then goodwill and other intangible assets were impaired. The impairment of the goodwill relates to 100% owned subsidiaries, right? So that will basically be sum of all this thing, which will be this figure from here, and then this impairment figure will be balancing figure, right? This minus this 26.5. So what was all this impairment was associated with thingy, right? Impairment of goodwill. So what about impairment of intangible asset? Let's not forget that as well. There is intangible asset as well. Intangible asset, right? So what's our opening balance over there? P test, right? So our intangible assets opening figure for intangible asset, other intangible assets, right? 240 and 150. 240 and then 150. Okay, so it has gone down by that much. That means this will be 0, right? Since there is no acquisition, no purchase, so it will be 90, right? So we will need to subtract that as well. I'll move this down. Impairment of other asset. Once that's done, let's go over here. Goodwill. Impairment of goodwill is working note 4. Working note 4. This should be working note 5. Working note 5. So what is this? Is equals to minus 26.5, and then this is minus 90, right? Okay, so once that's done, so what's our service cost, right? So service cost, let's look at it. There is some problem with that as well. It's already been calculated. But what it has done is that it has also included of this, right? Of the acquired subsidiaries cost was also included. Was 6 million. Okay, and then Angel had included the obligation assumed on the purchase of Sweetie, so that 6 million won't have any effect over here. So that included the obligation on the purchase of Sweetie in current cost of, although the charge to administrative expense was correct in SOPL and other comprehensive income, there were no tax implications regarding the okay. So working note 6. Retirement benefit reconciliation. First thing first, net what is over here? Net defined benefit, net obligation at 1st December, right? Net obligation at 1st December 20x net obligation, and then we will have net interest, and then current year service cost, and then we will have contribution paid, and then benefits paid, and then when you add all this thing up, you will have a subtotal over here. Subtotal UTL, and then remeasurement component which will be balancing figure, right? And what about the total will be net obligation at 30 November 20x3 20 0x3 November, right? So let's put in the values. So which is 74 and 80, right? 74 and 80. 74 interest expenses, 3 contribution into scheme, 9, right? So 3 and then contribution into scheme minus 9, so we'll reduce our liability. That's why it's in minus. Benefits paid will be 0 always, no need to worry about it. So total will be over here. So first thing first, let's look out for this current year service cost is 8, right? So 8 minus how much was for that Sweetie? Sweetie's obligation was 1, right? So that was also included in that. So we will need to eliminate it. So 7, right? So what will be our total? Sum of all this thing, 75. So 5 is our nope. Where is our, what is our in? Okay, remeasurement component is 4. Okay. So this is 4, right? That means this figure should be this minus this 76, right? So in this case, what we will need to do is that this will be 8 itself. But 76 and then 4, right? Okay, so what will happen is that basically so 11 million is our service cost, right? Total service cost, which includes the carrying amount of subsidiaries defined benefit obligation at the acquisition date, right? Therefore, the actual expense will be 10 million, which is 11 minus 10, right? This is added back to reconciliation before PBT, right? That's what we are required. So, what we will do is, when was the entity acquired? Let's look at the date as well. That's more important. On 1st December. Okay. So over here, what we will need to do is that, so as per this, what's our actual expense? Uh, this was 11, right? Whereas this figure included the amount for Sweetie 1, right? So how much was only charged in its individual statement was this figure minus this figure, right? Because they are not going to charge it for Sweetie because it's a subsidiaries company. So in the profit before tax of the parent, right? So what they will basically do is that, so they will not be charging this amount, right? That's why we need to figure it out ourselves. Okay, so the one will be, see, because why are we adding it back? Because from the profit they had reduced 10, right? That's why we will need to reduce only 10 from here as well, or I mean we will need to add it back. Okay, so where did we get this figure from? Working note 6. Interesting, right? This figure, okay. And then after that, are we missing anything? What about financial asset? I saw something about financial asset as well. Was there any selling in case of any other items? Okay, this thing PP is already been solved. Impairment has already been charged. Intangible asset is already done. Investment in associate will come at. It's already been subtracted from PBT, right? Okay, good. And then financial asset. Okay, so 215 and 180, right? 215 and 180. But let's look at financial asset. What has happened to financial asset? Somewhere around over here. Where was it? Okay, over here. So there is a reconciliation, right? So carrying amount was how much? Sale proceeds was 40, and then carrying amount disposed of was 26. Okay, the 14 will be our profit, right? So that will be included over here. So financial asset, financial profit, financial asset, profit on sale of financial asset. What I'll do is just put it over here. Gain on sale of financial asset. Asset, right? This is basically, what is the figure? 26 and 40, right? 40 minus 26, so 26 minus 40, because we will need it in negative. So this is working note 6. Okay, so what I'll do is, let's prepare a working for financial asset as well. See what's happening over there. We will need it for investing activities anyway, so do we really need it? See, because what has happened is, in this time frame we purchase this much. Okay, so it's already given over here, so this will be our purchase, and then this will be our cash received, right, which we will include in thingy, in investment activities, so we don't need to prepare it. Nothing to worry about it. So let's not waste time. Let's move on to add it up. Depreciation is not minus. Anything else that I'm missing? This is positive figure, because the impairment is already been reduced, right? So it's add. Okay, I think it's good now. Anything else? Gain on this will be subtracted. Gain will be subtracted. Okay, service cost will be, it's been deducted from SOF. Okay, good. Working capital, changes in working capital. Capital, right? So first thing first, inventory, trade receivables, trade payables. Right. So payables, this will give us cash flow from operations, and then interest paid, tax paid. I'm missing something over here. So control X B. So contribution into scheme. Okay. Scheme. This is from working note 6. So that's a cash outflow from the company, right? And that's why we will need to put this figure in as well. So contribution paid is -9, right? Yep. So why has not this figure changed? Is to do this. Okay. So what has happened with inventory? Let's look at it. So there is a acquisition as well, right? So what do we do for acquisition? When was it acquired? On that date. So it was acquired on 1st December, right? So what is our inventory currently? So it was acquired on that date, so it means it's already been included over here, not included over here. So 155 and 190, right? Where is that? 6. Okay, 6, and then what was the other figure? 190. 190 minus 6, right? 184. So 184 is our actual comparable figure, and then it has gone down by 155. So there will be a positive inflow, right? So minus 155, minus 155. Now this is not included in this figure. That's why I need to add it up, because this is for the closing year, and when we acquired it only on the next day, right? So it's not included within this figure. That's why I'm adding it up. So 180 receivable as well. 180, 180 plus, let's include this figure, let's make it comparable, plus 3. So how much is it now? 183. So let's see the changes, what has happened. 183, so it has dropped down, right? Receivable has gone down. That means 183 minus 125, minus 125, receivable has gone down. That means cash has come inside the business, right? So what about trade payables? Payables is not within this page. Payables. So trade payables 138, 138, and how much is this? Payables 4, right? 138 plus 4, 138 plus 4, 142, and then what? Now the figure is comparable. Let's compare it. Payables has 155, right? Okay, so it was 368, 361. Okay, I made a mistake over here. 361, 361. It was 365, and then after that it has gone down to 155. So that means so 155 minus this figure and this figure, that means cash has gone out of the business, right? Minus 210. Okay, so this will give us our cash flow from operations, which is basically sum of all this figure, 194.5, right? So what about interest paid? Interest paid, remember there was something. So all finance costs were paid in cash, so we don't need to worry about anything regarding interest, right? So this will be minus this whole sum was paid. Okay, so since finance cost is a accrual based item, right? So the whole amount has been paid, otherwise we only record only the amounts that had gone out of the entity, right? So tax paid, we will need to calculate it in working note 7. Let's calculate tax. Working note 7, calculation of tax. Calculation of tax. So opening balance, tax for the year. Opening balance was, let's add two figures up. Opening balance, where is tax? I'm not over here. 138 and 31. 138 and 31. 138 plus 31, right? Okay, tax for the year. Where is our SOPL? So what was the tax expense? 46, 6, right? And then what about uh, anything regarding this? Anything on OCI? OCI is 2 and then 3, right? Okay, so tax for the year OCI, right? OCI in bracket. Okay, OCI, which is basically 2 plus 3, right? 2 plus 1 plus 1, isn't it? Yep, items, tax item is this. And then let's look at acquisition. What has happened? There has been something over here with acquisition. Acquisition, right? So in case of acquisition, our tax liability has gone up. Yep. See, 1.5, which is from working note 2. Working note 2. And anything else? Anything else? Anything else? I don't think there is anything else. Closing balances. Closing balance is which plus which, 49 and 35. 49 and 35. 84, right? So what's the sum of all this? 19.5, right? So this minus 19.5. 19.5, right? So this was the tax paid, which is balancing figure. Right, so what we will do is we'll just bring that figure over here, and it will be in minus because that is cash outflow from the business. So this will be our cash flow from operating activities. Activities bracket A, hold it, sum of everything. Why is this function not working? Plus this plus this, 48, right? And then cash flow from investing activities. First thing first, receipts from sale of PP. Yep, PP. This is working note number 1. How much did we receive? What was the disposal proceed? $63. Yep, that was the disposal proceed, right? 63, and then purchase of E. This is working note 1, not the above. Where will that be? Where will that be? Purchase was this figure, right? was this figure, but why is it minus? Oh, I changed it earlier, that's why. Okay, now it's good. It is 66, right? And then after that, so what have we sold in case of assets? Let's look at assets. What's there? Goodwill, no need to worry about that. Other other intangible assets. Was there any purchase of that? Nope, only impairments. So nothing else regarding that. Intangible asset is also not there. No need to worry about that. What about a financial asset? Yes, there has been a few movement in that. So financial asset, right? What has happened? So there has been a sale of financial asset. Financial asset. Yep, it's already over here. So receipts from sale of financial asset. Sale asset. It was 40, isn't it? 40, and then disposed of was 40, right? 40 was the sale, and then how much did we purchase? Was there any purchase? Yep, purchase is also there, 57. Purchase of financial asset. Financial asset. 57. 57. It will be minus, okay? Minus. It will be minus. Anything else? What about we did purchase subsidiary as well, right? Isn't it? So how much did we purchase it for? Subsidiary. Hmm, 30 million and minus 2 as well. So net purchase, okay. Why are we using that figure? Net purchase of subsidiary is because we need to minus 2, okay. So see what it has is that it has a cash and equivalent of 2, right? So what we are basically saying is that even though we paid 30, we have only paid 28 because 2 has come into the business. So this 2 is the cash that we have control over it, so that's why we subtract it, okay. Always remember that. So the cash that we have acquired, we subtract it. When we are disposing any subsidiary, the cash that we've lost control over will be also subtracted from the from the proceeds, okay. So we always use the net figure. So anything else? Associate. Associate. We have not done anything regarding that. Have we already done it? No. Working note 8. Bold it. Let's use our classic template. Beginning of the year, I think it was 0, I guess, isn't it? Yep, 0 and then 80. Closing balance was 80. And then what was the acquisition? How much did we pay? In case of associate, 30% acquisition of the associate was this much, right? So made a profit of 40, paid a dividend of 10. Okay, so 40 into 30 to share of profit. Share of profit, right? This is not there. E into 30% only, that's our share. And then in case of dividend as well, by dividend, this will reduce the value, right? So which will basically be 10 into 40, 0.44, right? So this will be sum of all this, and this figure will be this figure, right? So how much did we actually pay for it? To cost of acquisition is this minus this 72. So that was the cash outflow from the company, right? Minus 72, purchase of subsidiary. And anything else that we had received? Yep, we had received a dividend as well, right? So that will be working note 8. Working note 8, right? So dividend from associate. Note 8. How much was it? In 40, right? Was it 40? Yep. But it's our holding was only 30%, isn't it? I think it's only 30%. Yep, it's only 30%. This was only 30%. Okay, that's good. Okay, once all this is done, are we missing anything? I don't think so. Let's use net, okay? Net cash flow. Same thing over here as well. Net cash flows from investing activities. B. This will be sum of everything, right? Minus 61. So to 63, and then after that why is it 72? It should be 71, isn't it? So minus this figure, right? This figure, okay, I have not linked it, that's why. Purchase of subsidiary is also minus plus, okay. So cash flows from financing activities. What has happened with share? Whatever, let's look at that. Share capital has increased, right? Okay. Issue of share, which is basically how much is it? 850 minus 625, or we can see at that 865 minus, or what we'll do is let's look at statement of changes in equity. It'll be easier from here, right? So 225 was the added share, so that will bring in money into the business, right? So anything else? Okay, so let's not forget there was a loan as well. Loan. Is there anything regarding loan or the venture? Long-term borrowing. Long-term borrowing. Repayment of long-term borrowing. Long-term borrowing 26 minus 57. 26 minus 57, because it's a cash outflow from the company. That's why it should be in minus, right? Anything else? So I don't think there is anything in non-current liability. Okay, let's see over here. So dividend, right? Okay, dividend paid to shareholders. How much did we pay them? That's outflow from the company. 10 minus 10, and then dividend paid to NCI. Right, which is minus, how much dividend did we pay them? Minus 6. Minus 6, that's the outflow from the company. Anything else? Nothing else, I guess. Any lease payment? No lease, I guess. There is nothing about lease. Lease liability is not there. Okay. So this will be our net cash flow from financing activities. Financing activities will be sum of all this. This will be in bold, right? And then this will be net changes in cash flow. A plus B plus C. So what we will do is this plus 48 here. And then what was our opening cash? Opening cash, add opening cash and cash equivalent. Valent will be this figure will be, where is our cash and cash equivalent? 355. So 355, we should get the other amount, otherwise we made a mistake. So this will be our cash and cash equivalent end of the period. Right. So are we correct? Yeah, 465. Good. Okay, so that's pretty much it, guys. So, okay, we do have one more question, right? So B number as well. So we will need to discuss about that. So it's already been too long. So what I'll do is I'll do that in next part. Okay. So if you've got any questions until over here, please do comment down below. I'll definitely answer it for you. So I'll see you in next part. Bye bye.